Hello and welcome to another episode of the Minor Issues Podcast. I'm Mark Thornton at the Mises Institute. The classic example of capital consumption is the farmer who eats the seed corn for next year's crop out of hunger and desperation. The seed corn is a vital input into production and spells despair for the farmer's future. It also spells future prosperity for the more fortunate and forward-looking people who did not have to eat their seed corn. The basic problem of capital consumption is much more complex in a modern capitalistic economy and is downright unseeable in a world dominated by fiat money until it's too late. Under these circumstances, economic theory is king. Most economic and financial commentators have no understanding when it comes to the topic of capital consumption, what might be causing it, or understand its implications for the future. I found one exception to this generalization in a podcast from a couple years ago featuring famed natural resource investor Rick Rule. Below is a clip where he discusses his basic premises and the problem of capital consumption. The interview is remarkable in that he explains the concept of capital consumption. He actually refers to eating seed corn, and he clearly explains some of the institutional causes brought about by democracy and its implications for the future. He clearly understands both the proximate causes and effects of capital underinvestment. And later in the interview, he clearly understands the implications of the policies of inflation on the various precious metals and the US dollar. However, in a podcast interview, it is difficult to connect those two things as the cause and effect of capital consumption discussed here. Briefly put, an expanding economy depends on savings to produce low interest rates and encourage capital investment. Increased capital investment has a salutary effect on wages, incomes, economic development, and growth. Savings is kind of a raw ingredient that ultimately produces prosperity. Easy money policy, aka inflation, changes the relative value of the money unit and confuses market participants and economic calculation in general. It reduces the interest rate in the short run, leading to decreased savings, but with the perceptions that people have greater wealth, just like magic. Based on this misperception of increased wealth, capitalists will often be induced to consume more of their capital, having fallen into the lap of luxury. This phenomenon is amplified over the business cycle when entrepreneurs take the low interest rate loan capital and invest in booming industry and bubble assets, only to be later caught holding the bag during an economic crisis. Government spending and debt also increases capital consumption when capital and the income of capitalists is taxed to provide for government expenditures, forcibly diverting it away from capital maintenance and renewal. Remember, capital is private investment in factors of production that produce goods on which consumer incomes are ultimately spent. Government never truly invests in capital, even if it looks like a capital good or is something that people willingly use, does not qualify it as capital. From the political decision maker's point of view, it's just another way to buy votes and to pass out the loot. It is important to realize that capital consumption is a very complex process that occurs during what is perceived to be normal conditions. The entrepreneurs and capitalists, as well as their accountants and minor shareholders, are largely oblivious to what's going on. Now, compared to the capital destruction that occurs during war, the effects of inflation-induced capital consumption beyond the normal consumption activities of the capitalists can be just as catastrophic, and Argentina is a great case in point. Now, in Das Kapital, which is clearly Karl Marx's most important book, and capital is one of his most central concepts, but it is also one of the easiest aspects of Marxism to evaluate and debunk, because the evidence against his hypothesis is ubiquitous throughout history. It is compelling in its magnitudes, and it is everywhere around us. Basically, Marx thought that the accumulation of capital or wealth was good for the accumulator, but made everyone else worse off. In contrast, economic theory demonstrates that the accumulation of capital makes everybody better off, including bums and beggars. Even Marx himself realized that capital accumulation was a necessity for social and economic development. Now, the accumulation of capital or wealth is usually thought of as in terms of stocks and bonds, but in reality, those are just tickets representing property rights to businesses that in turn own things like natural resources, real estate, factories, machinery, computers, warehouses, distribution systems, retail outlets, and intellectual property. So how does capital benefit labor? The economic law of returns tells us that the entrepreneur will find that the amount of additional output from adding additional labor to a fixed set of capital goods eventually declines. Wage rates and product prices are not truly set by the entrepreneur, but are really determined via markets. So the law of returns creates both a limit and a target for the entrepreneur in order to maximize profits in the short run. When capital is being accumulated in an economy, it means labor is both more productive and is in greater demand. Wages rise, living standards increase, and prosperity expands. There are no counter examples to this. Highly capitalized economies, whether historically considered or geographically considered, produce high-wage jobs, and economies with little capital are primitive in comparison and exhibit widespread poverty. This means that widespread capital consumption creates economic stagnation and decline. The very nature of capital goods is that they depreciate over time and with use. Entrepreneurs must continually invest in maintenance, repair, and replacement of capital to prevent economic value from declining to zero. Sometimes this does happen when the final product becomes obsolete, like buggy whips or floppy disks. For an economy to grow and for prosperity to expand, even more investment is required. And please send me your favorite example of historical economic declines, and I'd like to do an episode on one of those. Government inflation policy pushes an economy towards capital consumption by inducing entrepreneurs to underinvest in things like maintenance, repairs, and replacements. Artificially low interest rates, another impact of inflation, induces capital into bad investments in advanced technology that often end up as complete busts. Government exacerbates capital consumption by diverting our savings away from capital formation down the black hole of government spending. In recent decades, governments around the world have engaged in extensive inflation and deficit spending, but they have also engaged in a massive and very successful propaganda and policy campaign against capitalist production and resource conservation in favor of environmentalism. This means, in particular, that investment in extractive industries and the production of basic commodities has probably been particularly insufficient, and that those holding extra seed corn might be in a good position to profit from this ill-intended political campaign.